Hello everyone, how's it going? In today's video, we're going to be talking about Spero Therapeutics, trading under the ticker symbol SPRO. This is yet another company that has recently gathered a lot of interest from the trading community. Now, usually I would say, from mostly retail traders, but in this case, it's a little bit different, and we're going to talk more about this in just a bit. So before I go forward, here's a quick reminder that anything that you see or hear in my videos are simply my opinion on things. It should not be the only source of your decision making, like documents or information. Now, basically, SPRO has gathered a lot of interest recently because they got a big contract with GSK PLC, which is a massive player in the pharmaceutical sector. And thanks to this new contract, they can now get a new revenue stream from a major player. The reason why I want to emphasize on major player is because with bigger companies, even though we can always say they're slow, they're bureaucratic, it's office politics and so on, it also has the benefit of when they say that they're going to pay you, they will pay you, right? And it's very simple why they would. This is because whatever they have to pay a much smaller company, it's going to be a drop in the bucket for them. So it's not really going to make or break a big corporation. So this is why it's a really good news. And of course, the market reacted very actively, proactively even, and favorably to this result. A lot of people are now jumping on the bandwagon, hoping that more gravy is going to come to them. So is that going to be the case? It's both yes and no, depending on your time frame. And to be honest, this is precisely why I want to make a video about this small cap company. Because if you're one of the people who are interested in purchasing SPRO, then please keep watching this video until the end, because it may contribute favorably to your decision making, right? To make better calls about which companies you want to put your own money in. So when it comes to the company's own fundamentals, SPRO is a multi-asset biopharmaceutical company. What this means is that they have multiple product lines that are either being developed or they're simply, getting ready to be sold. Or in the case of GSK, they're ready to be licensed and monetized. In fact, maybe we should say monetized when it comes to pharmaceutical companies. As far as we are concerned, it's always going to be, are those products ready to be monetized by a third party, right? They can be closer or further from that stage. But ultimately, this is what it is. The sector by itself is a volatile one. It has a lot of potentials. The valuations are less out of whack compared to EV companies or tech growth stocks, but it's still higher than most other industries. The multiples are higher, in other words, and people are willing to put in a lot of goodwills, intangibles, and so on in the valuations. I'm not saying that they don't have any value, but they tend to boost artificially how much a company might be worth. There are also more contingency liabilities. What contingency liabilities mean is essentially things that are not sure to happen, but if they do, they're going to end up having more expense and liabilities for the entities to incur them. The typical example would be a lawsuit. We don't know what the lawsuit's outcome is going to be, right? So this is why it's contingent. But if the lawsuit doesn't go our way, then this lawsuit would end up having a sum of penalties that a company would have to pay. So this is why it's like a contingency liability. This is especially relevant for pharmaceutical companies because their products may result in class action lawsuit. And also, consumers at large are used to the idea that sometimes pharmaceutical companies get sued because, they're dodgy, maybe because they've been selling stuff to people who should not been anywhere near this product. Just think about Purdue and more recently ENDP. I'm not saying that ENDP is necessarily going to lose that lawsuit. I'm just saying like this is almost like a theme for pharmaceutical companies. So if SPRO continues to be developed, at some point it's going to meet the same issue when it comes to contingencies. A quick look at the website gives me the feeling that this company is promising. It is showing a lot of potentials. It is demonstrating that it is serious in developing real treatments for the clients, or rather the patients. But in this case, it's almost the same thing. Nevertheless, it's a small cap company, so tread carefully, and I want to explain why. Smaller companies are double-edged swords. They're also less predictable than the larger ones. So for small companies, they can be very volatile, up or down, massively. This is the good part, because as traders, you need volatilities in order to make money. We're not here to get the dividends or the interest distributions, right? So this is why ultimately when it comes to startups, or when it comes to companies that are still in the relatively early stage of their existence, this is something to keep in mind. The other thing is a small cap company is easy to enter. Well, actually, it's not even easy to enter. It's more like when you enter in a small cap company, it's less obvious that the volume could cause some issues. So for example, if you go in heavy in a stock like this, what ends up happening is even if the stock price goes in your direction, in the direction that you wish that it's going to go, it could get still like messy or sticky when you try to exit this position, because there's not enough volume to support that kind of sell order. And if that's not the case, then the market is going to go to the next bidder, and the price that it can be traded at, like at the market rate, could be extremely low. And for this reason, I would say, first of all, maybe consider not to put in too many eggs in the basket of penny stocks, or in this case, like low market caps. And the second case, I would say maybe don't sell your stocks at the market rate, right? This is not Google. This is not Amazon. It's not like the price that you see on the chart can be taken in no matter how many shares you currently have on a human scale, not from like the institutional scale, of course. So it's always recommended in those cases to use like the sell orders. You sell those stocks at a certain price. If they don't reach that price, there's no transaction. Because it doesn't mean that the stock price will not move in that sense. It just means that momentarily, it doesn't really have enough volume to support those transactions. But they're going to occur in time, right? So just give it the time to run those trades. When I also look at the financial data of Spero, this is maybe a little bit more worrisome, but then again, they're actively controlling things, so they're not too bad either. Both cash and revenue have been declining on a year-to-year basis. The expenses are increasing, but mostly due to non-routine operations, such as restructuring. So far, the liquidation of the marketable securities and the sale of other like operating assets keep the ship afloat, meaning the company still has enough cash to fulfill its current obligations. Just 2 words about like marketable securities. Some may be wondering how come a company like this has like marketable securities, like stocks of other companies, right? Because it doesn't necessarily make sense for a company that's supposed to be doing research to have like shares. But this might be the result of a company having too much cash to know what to do with it in the immediate term. Like, Let's say I have a restaurant. The restaurant is a small local joint, and suddenly my cash account has like $10 million in it. Well, even if my business needs this kind of capital, it doesn't mean that I have to spend it all at once, right? Because this will result in huge waste. This amount of money will be spent eventually according to the business plan, but in the meantime, it may take a few years, at least many months, before this whole thing sees through. So this is why, in the meantime, some companies may choose to put this money into an investment account, like a corporate investment account, and to yield some dividends and interest. It's just that simple. And when the company needs that money, they're going to liquidate the assets and then pull the money out. So based on the financial statements, things are relatively under control, right? They need time to blossom further. They need time to become profitable. And in the meantime, the company is actively controlling the debt level. So far, this is hopeful, I guess, but it's also something that we have to keep an eye on. Oh, by the way, the company is not profitable on its own for the moment. So its capital has to come from either debt or equity raise. The market data suggests that currently the interest for a short squeeze is very low because the total volume of shorts is around 3%. Usually we need about 10 to 15% to say, oh, maybe there's something going on. And then usually above 20%, this is where things could get somewhere, right? If a lot of retail traders start to buy the shares at the same time, then it's possible that those substantial amounts of short orders are getting ousted, are getting redeemed. Overall, I think that the structure looks reasonable because there's about 60% of institutional owners holding it. And this is a very good thing because this suggests that the company is legitimate. And I want to see this for any sort of stocks that we have to keep over the long term. Now, regarding the trading approach, I would say the following. People who are comfortable with a lot of risks, with the industry that is the pharmaceutical industry, and who also have a diversified portfolio should correspond to the perfect profile for SPRO. Oh, I'll add in another one. They should be willing to hold it in the long term. They should be willing to play the long game. If they do, this is a decent stock to get in. Okay? If you think that pharmaceutical companies are too unpredictable, they're relying far too much on whether their tests are positive or negative. In other words, if you fear that pharmaceuticals rely too much on faith alone, then maybe the stock is not for you. Same goes for pharmaceutical stocks, right? To each their own. For example, for me, I really have to think twice or maybe thrice before buying a pharmaceutical company. My portfolio is relatively diversified, but even then, I would think twice about buying even just a little position of SPRO at the moment. But that's not because of SPRO per se. It's more because on a personal level, I am more comfortable with a portfolio in more conventional and predictable sectors. Okay, that's just an example. If you have experience trading penny stocks, if you have experience trading pharmaceutical stocks, then definitely this stock is something that you should, at least consider. Now, when it comes to the current momentum, I think that it's already behind us because the current momentum happened as Spero entered into a deal with GSK. That's the reason. There's not much else. But the current hype is probably going to just cool down over time, so the short-term gains are unlikely to occur very quickly if we go in now. On the other hand, despite the volatilities, there is real possibilities for further long-term gains, simply because the company is very active in researching new products. So, with that being said, I would say that if you fit the profile of the traders that I described earlier, then I would say, maybe you can give SPRO a shot. So I would recommend the dollar average in this position simply because we don't know where the hype is going to go and how low it could potentially cool off. So I believe that for the next 6 to 9 months, it's a smart move to dollar average in a position for SPRO at about 1% of the portfolio. Now, given the current market environment, I believe that the equity market is in a vast phase of correction, especially when it comes to tech and growth type equities. The financial market has been living and breathing thanks to the continuous creation of new capital with different waves of quantitative easings, which will have consequences on the price of assets as well as their yields. With the interest rates kept relatively low over the years and the increase of amount of capital in circulation, this will keep putting significant pressure on the profit that we can expect the investment products across the board. And this, by the way, is a reality that may shift in the years to come if the interest rate of core infrastructures within our globally financialized system increases. It's useful to remember that the market doesn't represent the real economy, and of course, the real economy doesn't always reflect in the stock performance, since the name of the game here is ultimately called supply and demand, which depends on a whole bunch of factors that go way beyond our own control. If we think about it, this is like saying, if your neighborhood house that is put up for sale is only allowing those who actually want to live inside to buy it, versus if you allow every single type of buyer with different intent or reasons to buy or to sell it. So obviously, there will be a significant difference in the price of this asset for those two scenarios. The market currently works more like the second option, and assuming that it would only reflect the fundamentals of the underlying economy would correspond to the first option. There are a few elements that are considered to be the reasons. The first one is the significant increase of amount of money printed by the central banks around the world, which is then distributed to the banks with the expectation that they will be loaned to businesses. Normally that's a good thing, but with a lack of opportunities in the real economy, the significant portion of that money actually went back to the financial system to buy up the price of existing assets. Now that the QEs have been wrapping up or ended around the world, I think that this drive behind asset price may no longer be as relevant as it is right now for the future. It is now compensated by the arrival of capital from one region to another, and from one sector to another even within the same jurisdiction. With the increase of tensions around the world, capital is always looking for a safe haven to park their money into, not just for a place to grow the nominal value, but with a currency that tends to keep its purchasing power as well. The third factor is the creation or the birth of artificial bubbles, either maintained by the market trends built up over the years or out of necessity. Capital needs to find a place to stay. Some good examples of this would include the EV sector in the 2020 and the oil and gas securities when there are tensions around the world. Either way, when it comes to the price trends of the market, the degree of uncertainty is a key drive behind the price fluctuations, and that is likely going to increase as we go on from there. When companies announce that they are going to enter or exit different markets, or that they will be trading on different platforms and exchanges, this can all have significant ramifications on the price of this asset. Some of the considerations to have when operating in this context include having a clear view of what is going on, especially regarding the cash flow and the capital flow, and avoid certain potential pitfalls. One of these is to be careful with short positions. Inherently, short positions are riskier than long positions as the downside of long positions is limited, whereas the short positions can lose you as much money as the stock price may reach, which is infinite. On top of that, we're now seeing a new phenomenon with short squeezes, involving a group of retail traders propping the stock price up, forcing short sellers to recover their positions. Sometimes the attempt will not succeed, but sometimes they end up in very spectacular success. Something else to consider is to treat tech stocks with care. To start, ask questions when the price of a security skyrockets without real fundamentals. It doesn't mean that you shouldn't be touching it with a 10-foot pole, but it does mean that there should be a difference between the decision of long-term holding and short-term trading. Either way, a rule of thumb is that each position should be structured in a way so that their individual performances will never affect the portfolio's stability. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.